live. Will pumpkin spice lattes, warm winter sweaters, and cozy fires be enough to prevent the impending housing fall? Mortgage demand is on thin ice as buyers pull back from new construction. Pending home sales are down, and real estate CEOs are predicting the worst is yet to come. A perfect storm of epic proportions is on the horizon, and agents don't have a profitable compass to navigate this battlefield. So suit up with the armor of knowledge and This Week in Real Estate. Yeah, what's up, everybody? Hello, and welcome to another episode of This Week in Real Estate. Thank you guys for joining us.
Hi, Ray.
I'm Ray. Say hi, Dan.
Hi, Dan.
And that is Dan. Dan, are you cold? What are you wrapped up for?
Well, I'm just prepared for the storm in real estate that's coming, buddy.
Is this what you're gonna do? Your shelter? You're just gonna take shelter in a blanket?
I hope they'll just weather the storm, and I don't know how we're gonna get through this, Ray. I don't know.
I feel like not yesterday, but last week with our costumes, maybe we should have done a lot more with the skeleton, and fleshing something out and all that stuff. So I put up a very punny post on my Instagram feed from that. But I like the early Christmas. You've gone full Hobby Lobby on us.
Yeah.
Day after Halloween.
Like layers.
Day after Halloween, he's already in an elf cap.
Well, it's also raining here in Southern California, so it's we Californians don't do well with this.
So you do an elf cap because is that a California thing? The rain and
the heat in from escaping through my head.
Jeez.
Man, I put on a lot of layers for this joke.
You did put on a lot of actual layers. No one could tell when you're under the blanket how many layers you actually had on, but you went full out for the joke, for the bit. You layered up for sure. All right, guys, we're broadcasting in 4 different locations. We're on Clubhouse, so if you're joining us there, thank you guys for joining us. Feel free to come on up. We'll be inviting up people that we know. What's up, Mike? Howard's here. A lot of people here that we know. So Mia, feel free to come up and chat about anything that we're talking about today. If you're joining us on Facebook, you could comment and we could display your comment and talk about you or your comment, just like we did for Howard. He's also on Facebook. He says, "Hi, gang. What's up, Howard?" And then the first comment that we had over on YouTube today was 40 minutes early.
Dude.
Matt LaMarche, good job. No one is going to be first 40 minutes out. That means you've got your notifications turned on because that was right when we hit the go live button. So I appreciate that, Matt.
Yeah, he 100% has notifications on, which you all should as well.
Yeah, turn on your notifications. And we're also broadcasting over on LinkedIn. So thanks, everybody, for joining us.
If you happen to prefer LinkedIn as your oh my god social channels, then you can watch us on LinkedIn.
I was watching somebody talk about, they're really good on LinkedIn. Y'all may know her name, Shay. I was watching her talk about LinkedIn, and she said that if you're looking for a social platform to get started on, choose LinkedIn. I'm like, wait, why? And she said there's no haters on LinkedIn. There's no trolls because everybody's there to make money. So you post something and it's overwhelmingly encouraging.
Yeah, hey, dude, great job.
That's a legit point, man, because there's so many trolls everywhere else. We're going to figure out, so Instagram has some stuff that allows you to restream to Instagram. We're going to figure that out. It may have to be a different system, so I'm hoping that StreamYard picks up on that. I've got a lot of people that ask me, when are we going to broadcast on Instagram? In order to do that, we have to get StreamYard to pick that up. So we hope to do that in the future. But thank you guys for joining us. We do have a lot of news, as you heard in the headlines. We are waiting on breaking news today. So the show is going to go right until about 1 o'clock, maybe a little thereafter. At 1 o'clock, we should know what the Fed is going to do with rates. So before we get that far in the show, and if you're joining us on Clubhouse, drop in the chat after you share the show on Clubhouse, drop in the chat, how many basis points do you think the Fed is going to raise the rates? Do you think they're going to not raise the rates? Do you think they're going to go up 75, 50? The general consensus, most people think it's 75. So I'll let the cat out of the bag there. However, we did see that Canada, which Olivia tipped us off to last week, Canada only raised their rates 50 basis points last week.
Only.
And America followed them. The last time that Canada made a huge jump, America was like, "Oh yeah, we're going to do that too then." So I could see this administration following Canada in that saying, "Okay, well, let's do that because that's what they did."
Well, the actual president doesn't know who the actual president is, so why not follow Canada?
That's right.
I don't want to
LinkedIn user Matt LaMarche
no. LinkedIn
has
user.
a life of Olivia. 50 points, says Matt. Winter is coming. All right, so we got 75. Mike V says 75. 75 next time, but leave the door open for less. ECB went 75 this week. Okay, so yeah, most people sounds like they're thinking 75. Some people say 50. Olivier thinks 50. I'm a little, if Canada did not come out last week and say 50, I would say 75 this week for sure. But because they said that, I don't know. It makes me, maybe they'll do 75 this time and 50 next time. A 75 basis point increase again that's a lot.
That's a lot. That's what I'm saying. Every other adjustment has followed Canada, right?
Yeah. Well, I mean, in part because they're a week ahead of us in when they raise the rates, and they're also in an inflationary environment. So it's not really like they're following Canada. 50. They just happen to be releasing at the same time.
I'm going to say 50.
That's right. 50. So you're saying 50. Since you said 50, I'll say 75.
There you go. 50 basis points. Let's see the epic battle between Ray and Dan. Let's see who wins.
So yeah, we'll be listening for the breaking news sounder. This is what this sounds like. Breaking news from This Week in Real Estate and the bearded men of real estate. So as we hear the breaking news sounder, we'll know that the Fed has released its minutes. We'll hop over there. We'll get some commentary on it and talk about what you guys think. Dan, until we get into all these headlines, because we do have a lot to get into today, would you tell people what this show is actually all about?
You know what, I'd love to. Now, when Ray and I met here on the interwebs, it was on Facebook. Geez, I don't even know. 5-6 years ago, we met in a.
It had to be 6 years ago now, because the show is 5 years old.
Right. We started doing it. It's at least 6 years then, because I think our first episodes, which are on YouTube.
Yeah, we knew each other before those episodes.
For a while. It was months before, a year before. But we were in a pretty large real estate group that got even larger before we vacated the premises. And we always ended up in the same sub comments, kind of subtly trolling others. And I can guarantee you that some of those people we trolled still don't know they were trolled to this day, which is kind of the point.
Emotional,
100%.
That's very true.
But Ray and I had a lot in common and still do to this day. We realized we had a good balance of kind of, left versus right, and just kind of, it wasn't just the beards we had in common. But at the time, I had an idea for a show called The Bearded Men of Real Estate, which is now This Week in Real Estate, because the bearded
no one knew what the bearded men of real estate was.
No one could understand what we did. So is it beard products?
Yeah.
No. Anyway,
I told somebody I was on the Bearded Men of Real Estate, and they were like, "So you'll talk about what, like beards and beard products and housing?" I'm like, well, half right. You're half right on that.
You're a third right there, but
third right.
But when I met Ray, I noticed something very interesting about him.
What's that, Dan?
He's never been on a submarine, not once.
Actually, I haven't, and we have a submarine here. I need to go to it. There's the SS Razorback or something like that.
Wait, and where is it? You don't have any water.
No, we have Mississippi River, man.
Oh.
We just have a major thoroughfare here.
But deep enough for a submarine?
But the SS is actually on the Arkansas River. And yeah, it's deep enough. It's deep enough. So I need to go. I need to go take a look, and you can take the tour. I feel like I've talked about this before. You can take a submarine tour.
I don't think you have. I always try to bring up something new just to learn a little bit about Ray.
No, yeah, you can totally take a submarine tour there.
Dude, that's awesome. But I obviously notice he's a beautifully bearded man, and I also notice that he loves giving value up front to not only his clients, but to humans in general. So the show's about being more as an agent, but also being more as a human.
That's right. And one of the things we believe about being more is to know what in the crap is going on so that you can consult with your clients and give them the best possible advice. We want one place for you to go and get all the headlines in about an hour, and we'll go just below the headlines so that you guys know what they're actually saying. We get away from the frightful stuff and get to the real stuff. Julie Moon found our first video. She said the first show on YouTube was October 11th, 2017.
Yeah.
This is show 208. That's a long time.
That's a lot. It's a lot. But Ray, you can, I mean, you're doing the same thing as me. You're rolling in all the money you've made from this show, so it's totally worth
Well,
it.
yeah, that's totally true. So whenever we first thought about this show, I don't think I've ever shared this on the show either, but one of the reasons why Dan and I thought this would be a good show is because the fiery contrast of our opinions. I don't know if you guys know this or have picked up on it or not, but Dan is kind of a left-leaning, bleeding heart liberal, and I am a very conservative, staunch guy. So we thought, oh, this is the perfect blend because we like each other and we can have these opinions on things and we'll still like each other. And that'll kind of be part of the show. It's like
It'll be fun.
Major disagreements. And yet, hey, we still like each other. We're friends. No big deal.
We're going to prove a point to the world, right?
Right.
Well,
and so I remember the first couple of the shows, I would bring something up and I'd be like, oh yeah, I know that I know where Dan is going to go with this, where he's going to. And so I'd like prep it and be like, oh, what do you think? And Dan's like, yeah, totally agree. I'm like, what? So one of the things we learned is around housing, we're very similar in opinion around housing and business, I guess you could say.
Yeah.
Mia as well. Mia thinks that there's going to be 100 basis points. So 1 point.
That's a full
raise.
point. So up to 8, she thinks.
Jeremy Galloway says 0.5. It's not Assad Tahiri. I may have butchered your name. He said it's not how much the Fed will raise rates today. It's what their comments may imply about future rate hikes.
That's a fair point.
Yeah. Okay.
And
they're looking for possible pivots. Possible pivot. That's
those comments, by the way, are from
Clubhouse.
Clubhouse. So if you guys are on the road or can't watch, you can go listen to us on Clubhouse or catch the show on all of your streaming platforms. It will be up usually about an hour, 2 hours after we finish here.
Yeah, and we also will have down in the description of the YouTube video, we'll have timestamps. We get that done in about an hour or two after the show now. There's full timestamps down there, and you can click on one of the things. Let's say you just can't wait until we talk about home prices falling faster now than in 2006, Redfin CEO's comments.
Yeah,
let's say that's like what you came to this YouTube channel for. You can just look down in the description. There's a little timestamp there. Click that, and you'll zoom right to it. All right. Well,
Julie, we may cover that.
Julie asked, we talking about the point spread for Georgia versus Tennessee? What is it? I don't even know. I would think you guys should be fairly worried about this little orange team coming in.
It's going to be pretty close. I mean,
I'm actually rooting for Georgia because I hate Tennessee. I've never liked them. So, okay. Let's see. You shared this room. Okay.
You don't like the volunteers.
Thank you guys for sharing the show. I can see some of these shares. This is great. I mean, their team is so bad they just need volunteers. All right. You ready?
We're not going to move past that joke, Ray. Come on, man.
Let's get into the headlines.
Okay.
It's a terrible joke. Delayed. All right. So first up on the docket, let's talk about mortgage demand. Mortgage demand falls as rates slip from recent highs. So last week there was an article that actually we kind of covered through some of our articles, so I skipped it. But the actual article itself was that mortgage rate demand was less than half of what it was the previous year. Again, mortgages continued to slip. Application volume barely moved last week, falling 0.5% compared with the previous week. But the previous week was pretty low. The slight drop was enough to move the needle only a tiny bit on refinance demand. Those applications rose 0.2% for the week, but we're still 85% lower than the week before.
I think it's crazy that there's any refinance activity going on.
Yeah. Well, I mean, I guess some people are in. Yeah. Well, I would maybe
they're higher than they've been in 10 years.
Tim could probably tell us why people would reach out to refi, but I guess if you're doing a BRRRR strategy or something like that, where you buy
or maybe a HELOC or something,
then you refi. I don't know.
Or a home equity line of credit, because technically that's a refi.
Yeah.
Yeah, there you go. That's what I was saying. Cash out. There you go.
Cash out or cash out refi. Yeah, okay. I can see that. Mortgage applications to buy a home fell 1% for the week and were 41% lower than last year. Real estate agents and home builders alike say buyer traffic has slowed to a crawl. Agents say that buyers see no sense of urgency, and some may be waiting for rates to pull back more significantly.
Now,
apart from the ARM loan rates and other loan types were more than 3 percentage points higher than they were a year ago. The elevated rates continue to put pressure on both purchase and refinance activity and have added to the ongoing affordability challenges, said Joel Kahn.
There it is.
Mortgage Makers Association economist. Matthew Graham, he's chief operating officer at Mortgage News Daily. He said, if they go so far as to throw a bone to the market, it would likely be good for rates. If they completely shy away from it, rates are going to have a bad Wednesday afternoon. Either way, volatility risk is high. I think that's what we talked about, is the word volatility to be thrown around like crazy lately.
Well, by the way, I did some research because all of this sounds like
Julie Moon says divorces. Those are some refis. Yeah, that's true too. Got to refi into your own name. Mike V says they need the dough. Olivier said, as I said last week, here in Canada, sales are down year over year by 35 to 40%. We should end 2022 around the 2017 levels in terms of the number of sales, the number of transactions total, right?
And all this
are you talking about volume, like dollars, or number of transactions? I think you're talking about the number of sales.
He mentioned number of transactions last week. Remember, he said 1,000 transactions for 1,500 agents in his area. So I think he means number of transactions.
I think so too.
I did some research around this, and because all these same things seem really, really bad. And I do agree. We're trending down, right? I think we have to after trending up for so long. But Ray, we still have an inventory crisis. We're still millions of homes short as far as inventory goes. We don't have enough.
Hang on. Oh, I thought we had an article that talked about that. Did we not?
I found one, but it's a video, and we can't really do video on the show because we'll get copyright.
Yes, I found that video too. So that is one CEO that's saying that there's I tried to find the article. So what CNBC does is they have, it's genius, actually. It's a great strategy for any media company or producer out there. Oh, Christina said she couldn't find us on Facebook. That's interesting. It's got a little check mark. But a great strategy for anyone in media is to use your lives and then chop up your lives and then write articles about them. That's essentially what MSNBC did. They interviewed a CEO who said that there's not enough supply, that there still is an inventory shortage.
Yeah.
And they haven't written the article around that one yet, but
we're still below. I mean, the chart I'm on right now, we're still below 2016 levels.
Oh, wow.
Like half.
I have to look up what we're doing. You know, there's a lot of companies not having a great year, and I'm actually surprised at how high. Someone asked me to look up the numbers for a specific company, so I looked them up, and I kind of looked towards the top, and there's not a lot of companies having good years here.
Yeah, I did send that article too. Coldwell Banker had a pretty good third quarter.
Christina Smallhorn said you could use clips. You could clip stuff and use it under fair use as long as it's less than 20 seconds.
There you go. It's the 20 seconds.
That's cool. Olivier said, medium term, the inventory will continue to be an issue. Short-term rental market is going to blow up as people do not buy. They want to rent.
So, Ray, going back to 2000, we are at roughly 2005 levels, 2006 levels.
In California?
No, this is national from realtor.com.
Okay. So nationally, that's where we are.
Yeah.
Now, that was a huge boom.
Yeah, they're up. We're on an uptick right now, but it's still just not enough. So we need to, I don't know, maybe do something to help incentivize sellers. I think I've been saying that for literally more than 5 years on the show.
Well, if that was the case, wouldn't you think that builders would be totally pumped about this situation? They ain't.
They're not.
No, this article says, builders say they're on the edge of a steeper downturn as buyers pull back. So builders continue to be extremely worried about the situation.
And this is
Once
after
hot housing market
builder
is cooling
sentiment
off.
goes down.
Yeah, builder sentiment went down, which we reported last week. Once hot housing market has cooled off at an alarming rate, and some home builders say it will only get worse as the new year orders dry up. Fast rising mortgage rates have caused once frenzied home buyers to turn their heels and become worried about potential investment and the health of the overall economy. Gene Myers, chairman of the Thrive Home Builders in the Denver area, said there's a cliff that's happening in January.
The coming January. Is that what they're saying?
Yeah.
So it's just going to go boop.
Yeah. They think the cliff will happen in January. U.S. home builders were a major beneficiary of the COVID economy. Housing starts for single-family homes dropped by 19% year over year in September, according to the U.S. Census building permits, which are now an indicator of future construction. They fell 17%. One of the nation's largest home builders reported its cancellation rate jumped from 15% in the second quarter to 24% in the third.
Now, what's normal? Normal, take out the normal part. Wasn't it 6 to 8%, something like that?
Yeah.
So
There's a norm. I mean, they have cancellations.
it is above normal, right? So
Way
these
above
aren't
normal.
just crazy cancellations.
Yeah.
But
no, I think there's a crazy high number right now. It's high.
I'm just saying, take account that there are always cancellations. I mean, not just new construction, just in all real estate.
Yeah, and I think we talked about this last week too, that a lot of this is because builders started building houses 8 months ago when prices and material were high, when the land was high, when the labor was high, and now they're sitting with these properties that they're trying to move. So we're seeing some builders go ahead and drop prices on that if they can maybe break even or get a nice, a slight loss or something like that. It still puts them able to build another house at a much wider margin, given the new price points.
I don't know. I mean, it is simple economics, Matt, but the next question I've asked already is, why aren't builders doubling down right now and building? This is because they got a plan for 8 months from now when the market, everyone is predicting, well, not everyone, but I've seen a lot of articles saying interest rates are going to be a lot lower in 2023. They got to plan ahead for that. If they don't build now, they're going to be a year behind.
When there's someone we read last week that thought that interest rates would be in the 5s next week?
Next year, yeah.
Next year, I mean? Yeah.
Yeah.
Nah, I wish next week.
I know. That'd be interesting after whatever the Fed says in the next hour.
Well, you know what all the real estate agents on the Instagram say? Marry the house, date the rate, right? Right? Is that what we're all saying? Is that all the best advice?
Are we still saying that?
Are people? I know Justin Conoco. Aren't you saying that, Justin? Isn't that your favorite thing? Sorry.
What's my favorite thing?
Marry the house, date the rate. Don't you like that? Isn't that a thing for the Instagram real estate agents?
I believe in polygamy.
Buy multiple homes is what he's saying.
Exactly.
So it's still interesting. Like the number one client that we're working with right now, they're investors. And so you would think that if investors are out there because they feel like they can find a good deal, wouldn't home buyers like be looking at this market going, well, we can find a deal right now. Christina Smallhorn says, I hate the date the rate comments. Yuck. Yeah. That's why I say it. Just because you hate it.
Yeah, he hates it too, but he knows that it gets your ire up. So he still says it.
Okay. So let's talk about pending home sales, because maybe, we're at an inventory shortage. Builders don't feel good about it. But maybe what we will be seeing is pending home sales are going up a little bit. Maybe that makes everybody feel a little bit better. Double click that one.
There's got to
you
double tapped it, dude. It got a headshot. there's got to be some feel good news here, and this is it, right? Come on.
Yeah. So pending home sales only fell 10% in September. Much worse than expected.
Only fell 10%.
Only fell 10%. So pending home sales, a measure of signed contracts on existing homes, dropped a much worse than expected 10.2% September from August, according to the National Association of Realtors. Economists had predicted a 4% decline. Sales were down 31% year over year. This marks the lowest level on pending home sales since June of 2010, excluding April 2020 during the pandemic. Realtors point squarely and sharply to higher mortgage rates, which had a record sat which had sat at a record of lows for the first 2 years during the pandemic. So a lot of commentators are saying basically those record low rates that we had were low for way too long, which has led to the situation which we're in, and now has to be overcorrected through the rising interest rates, which we were 30 minutes from. Average rate on a popular 30-year fixed mortgage was right around 3% at the start of this year, rose swiftly, crossing 6% in June, according to Mortgage News Daily, and then continued to rise, crossing 7% in September.
Has there ever been such a crazy rise? I mean, from 3 to 7, that's 4% in 10 months. Is that always a thing going? If you go back through markets, does anyone know? That's
pretty high.
Pretty high to me.
We can
That's
actually
like
look at
high.
mortgage rates. There's actually a chart on this.
Here, I'll look.
Wait.
I have a historical chart.
I just found a button you can share. Oh, that's nice. All right, I'm putting this up. I'm putting this chart up.
I mean, yeah, there's been some pretty good spikes in 1980. From February to
Oh, you're going way back.
Yeah, from February 1980, they went from 12% to 16% to 16.5% in a matter of 2 months. And then back down to 12%. And then in 81, they hit 17.5%.
Is that the 30-year fixed chart from Fannie Freddie?
Yeah.
Where's the actual chart? I'm seeing the numbers, but I'm not finding the pretty chart.
I'm on fred.stlouisfed.org.
All right.
And they've just gone down since that time in the last 40 years. Just down. 2014, they were super low, and then they obviously got super low in 2020. And now we're back up. But historically, we're still lower than, because all the recent stories say lower than 2000 or the same as 2009, 2010, but you can go all the way back. They're still lower than 1971, 50 years ago.
That's true.
That is an interesting chart that y'all should be looking up and showing your buyers right now. Ray, can you show that?
Yeah, it's up.
Yeah, that's the same one. There you go. Yeah.
So the next, it looks like the next fastest peak. This is like the third.
That one in
81
rise quick. That one was 4 points in 2 months.
Yeah, the like 1 month rise in 1980, and then the 2 month or 3 month rise in 1981.
Yeah,
and now we have this one in 2022.
Right.
Those were the three fastest peaks.
But I mean, 40 years between anything like that.
Yeah, but look what happened as soon as it went up like that. As soon as it spiked up, it came right back down pretty quick.
Relatively quick, which if we look historically, look at all those spikes, right? Look at all of them. They're followed by pretty sharp downturns.
It's a pretty sharp down. Yeah.
So let's all start thinking about our prediction show, which is going to be about a month and a half, about 4 or 5 shows from now. What are you going to predict for next year? I already have mine pretty locked in. So we'll see if that changes.
Well, and your local mortgage lender is going to love it if you say, "Hey, rates went up 75 basis points today." So does that mean my clients who are pre-approved for 5 are now at 5.75?
Yeah.
Your lender loves it to get that call.
Put that on an Instagram right now to everyone that Fed raised raised rates by 75 basis points. So now
right, Tim?
Your rate is now at 7.75. So put that out there. Go on Instagram, put it out there right now.
Yeah, Tim's in the clubhouse. Don't you love seeing that stuff? All right, we'll take some comments here. Matt said 2001, it was 8%.
2001, Matt was 4. You guys know that, right?
Olivier said the speed of this rise is pretty incredible. Michelle says she believes it's pretty excessive. Christina Smallhorn asked a question because we were talking about these pending home sales dropping. You know, we do point to it, but she asked, we do point to rates. She said, how many people took their homes off the market altogether?
That's not a stat.
Yeah, I mean, it is. I don't know how to find
canceled?
it. Every now and then they'll report on that, but it's usually when it's an anomaly of some sort. And I haven't seen that number reported in a while. They know that the inventory numbers are up, though, quote unquote. That was in Lawrence Yoon actually said that I was reading Realtor Magazine yesterday.
No, get out. No, you
Yeah.
were not.
I was.
You have to be farcical right now. No way.
I was reading my
Like
I
a
was reading
physical
my
magazine.
my Realtor Magazine the other day.
That's so
And on
good.
page 7, you have this from Lawrence Yun. See? And people on audio, you can hear the paper. It's real paper.
It's a legit magazine. Like they forgot
is
that
how
they
you-
can put things online.
This is how you screen share back in the day. You just hold it up to the screen.
Yeah.
You see this? All right, this little blurb says supply and demand. Total housing inventory for July was 1.3 million units, which was an increase of 4.8% from June. So very timely, getting the print version of the magazine
Yeah.
for fall to see that news that inventory is up in July.
Yeah, because I can guarantee people are not going to their website. They're going to the book, but they're not going to the website.
I don't have an update on that number, but the sources was NAR. When I saw that though, I was this just came. This is not one that's been laying around my office. Maybe I got it late. But it says on the front, fall 2022. You would think that it would be more up to date. I think you could go to magazine.realtor and maybe find a more recent article, but there it is.
That's pretty timely though, even though it is in print form.
Yeah. All right. it's bad. What are we going to do? The housing market's going to, and we're not going to have a job next year, right, Dan?
Yeah, that's what's going to happen.
And part of the reason is because home prices are falling now faster than in 2006.
You could almost say, Ray, that it's a legend of the fall.
Here's a real legend of this fall.
Uh,
Redfin CEO Glenn Kelman. He said this is on Fortune magazine or Fortune website, fortune.com. The pandy housing boom unleashed investor mania, unlike anything seen in the U.S. housing market since the August housing bubble. Average Joes poured into the market in hopes of Airbnb empires. Institutional investors like Blackstone owned Home Partners of America quickly expanded their single-family home portfolios. While iBuyers like Opendoor and Zillow ramped up their algorithmic home buying programs and failed.
and
Fast forward to October, and investor mania has been replaced by investor panic. Now, that's not what I'm seeing.
yeah, I
Now,
was just
maybe,
gonna say.
maybe that's because investors are dumping properties in some of these other markets where he's focused his money on, but they're not
Right.
seeing them pick up the ones in middle America over here.
Right. That's what I always wonder about this, the surveys and the studies, when they make this blanket statement about what's happening in the United States of America, but then they surveyed 2,000 people. Okay, well, there's more than 320 million here. So I don't know if that's a great cross section. And
It's not a huge.
right. And was it people from across the country? Because if you talk about things going on here in California, it's much different than things that are going on there in Arkansas as far as the housing inventory goes and other things. But that's I always wonder that.
I want to get to a quote by Mr. Kelman. It's probably one of my favorite quotes that he's ever said.
Ever.
To set up this quote, they talk about the investor pullback. While most housing economists don't foresee a correction on the scale of the great financial crisis, where home prices fell 27% between 2006 and 2012, they do acknowledge that the price correction is sharper than it was in 2006. Lagged Case-Shiller index already shows home prices down 8.2%.
They keep talking about prices. When are they going to talk about values? That's what I always want. There's no value talk.
Well, and that's why it was a correction, right? The great financial crisis was a correction when prices fell 27%.
Right.
And we talked about that. Once prices are falling above that, then it would be a correction. Historically speaking, home prices are still sticky. Sellers simply don't want to relent on price unless economics, like something forces their hand. So then he says, When the shiitake mushrooms hit the fan, you investors want to get out first. That's quote unquote Glenn Kelman, Redfin.
But when the Shih Tzu dogs hits the fan, is that he's just trying to not say?
When the Shih Tzu dogs drive their Mitsubishi. I mean, what are we doing?
Yeah.
When the shiitake mushrooms hit the fan, you investors want to get out first. He goes on to say that the way to do that is to figure out where the lowest sale is and be 2% below that. And if it doesn't sell in the first weekend, move it down again. And we do have some investors that are exiting here. You know, there's some that we've talked to that we've told them about how much it would sell for, and they always want a price above that. We're like, that's not what we said, but all right. It's a good chart. We like good charts. This chart shows the percentage of homes bought by investors as it changes between Q1 2021 and Q1 2022. So it's a little bit heady. Let me get over here and share the screen. And it talks about it in the context of markets. So Atlanta, Georgia is number one on this market. They had 22.7% of investors were buying homes, or homes bought were investors. That went up to 33.1% in Q1 of 2022.
Is this between like Q1 exclusively and then Q2 or Q1?
Yeah.
Sorry, Q1 2021 and then Q1 2022 exclusively, or that year-long time frame?
Q1 2021 and Q1 2022.
Okay, so
yeah, it's the year. It's over the year, but it's
okay.
Yeah. Charlotte, North Carolina was at 23%. They moved up to 32%. Jacksonville, Florida, 23%. They moved up to 32%. Those are the three highest. Next is Phoenix, Arizona, 20% to 29%. Nashville, which I'll be in Nashville in December. If you guys are going to go to that Sales Edge marketing conference, I'll be there. So hit me up. I'd love to meet up. 17% in Nashville to 24%. Those were the biggest. Those had the most. It looks like also those were the biggest jumps. I don't see anything that was over that number specifically, but there's some that went down. Milwaukee went down from 15% to 15.1%, so relatively flat.
Investors.
Seattle, Washington went down.
Ooh.
So from 10.6% to 10.1%.
See, I would expect the same in LA too, but LA is up, but not a ton. But
yeah, Los Angeles is from 16% to 19. Well, from 16 to 20.
That's still a pretty big jump.
Yeah,
but
I mean, it's
again, this is also
homes
early
bought
in the
by
year.
investors. Yeah,
this is also early in the year, not now.
So why was there an investor bull rush? See charts below. Into the housing market during the pandy, a combination of low mortgage rates, record appreciation, soaring rents. Of course. So these are the home flips in the U.S. It's a chart that's basically it looks almost like a heart. It's got a spike in 2005, then it goes down, and it has another around 50K flips, and it kind of slowly grows, and then boom, it spikes up to over 100K flips in 2022.
Yeah, a Q1.
That's the number of combined single family home and condo flips by quarter. So and Q1 of 2022 was huge.
How do they quantify that? Someone that buys it under an LLC or register
buy and sell, I guess. Buy and sell fast
the time
within
they
a certain
buy
amount
to
of time.
sell it?
Yeah. I thought it was an interesting article. It's over on Fortune. You guys can check it out. They also talked about, is there a place for home buyer or iBuyers in this whole thing? And kind of have that debate on there too. D Jones, she joins us on Facebook, says, "Hey Beards, what's up?"
I do. I am.
Christina Smallhorn says, "I like big charts, and I cannot lie." That's so good. Sorry, I was looking for my rundown, and now I don't see it. Oh, there it is. I replaced it.
Yeah, I know it was gone for me too for a second.
What's the other one on Forbes? There's another article on Forbes. House prices start to moderate. How bad could it get? It's kind of in the same vein that we just talked about, but I will share that one too. We can run through it. What's just happened? Pardon me, guys. Producing live on air.
Huh.
There it is. All right, so this is in the same vein as house prices start to moderate. How bad could it get? They talk about housing affordability, seasonality, what's happening in the season, what's next. Zillow data says home prices are up 13% year over year for September of 2022. They have fallen back month over month, but remain up for the year, which is why we're not in a correction yet. Closing the affordability gap. They think lower rates. All right, the first is interest rates, which have risen aggressively in 2022. If rates fall back, then affordability would improve. Currently, the Fed isn't expected to cut rates sharply, but it may at least pause rate hikes in 2023. A recession could cause the Fed to cut rates, especially if inflation is under control. Lower interest rates would improve housing affordability through reduced mortgage costs. Obviously, the real concern is the need to bridge affordability gap. And so we've talked about this. I saw somebody post something pretty good yesterday, and it is like a little bit simplistic. And there were buyers that we talked with last year, and they're like, well, we want to wait until it's less competitive. And so we're following up with those buyers now. And they're like, well, yeah, I mean, we love to buy now because it's less competitive, but the rates, we really need the rates to go down a little bit. You're probably not going to have it both ways in your lifetime, unless you find a specific market that is less competitive for some reason, and you could take advantage of a national lower rate. That would probably be what you're looking for. But if you're wanting to buy in like a regular city or town that is just a normal place to live, it's going to ebb and flow a lot with the rates. So you're not going to find a really low rate environment and a non-competitive environment. It's going to be really low rates and very competitive for buyers.
Yeah. Or high rates and less competitive.
Olivia says they want their cake and eat it too. Yeah. So really, I mean, what it boils down to, as I talk to our buyers, this is what they tell me.
They ask you how you are, you just have to say that you're fine when you're not really fine, but you just can't get into it because they would never understand.
No, we understand. We totally understand. You can get into it. We're here for you.
We understand very well.
All right. So we've been going through the news headlines. We've been talking about it. It's kind of a downer show. Would you agree in the comments? Downer, kind of downer, Debbie Downer, but we're talking about the realities of it. And we will tell you below the headlines if, somebody's just trying to, I feel like for years it was pomp and circumstance based on who the administration was as we were first starting the show.
Yeah.
Like the economy is terrible. We're sinking. We're crashing. And then you would read below the headlines. We're like, still up from next year, still up from last year. Last year was still looking good. And because the economy really was doing well. And now it's not. But you're not really seeing the dire straits in some of these headlines. You're just like, okay, pending home sales fell 10%. Much worse than expected. But then that's it. As you read the article, it doesn't sound as bad, but the numbers are telling you are not good. And everything
I think we need to switch up here a little bit, Ray, because usually we're like all these dumb doom and gloom headlines, and it's just to get clicks, and let's get you past the headlines. And now we're getting past the headlines going, I don't know, man. I don't think they're telling the full story here. I think there's a lot of realtors that are going to suffer in the next year. I really do.
Well, and so we're looking for a shot of positivity in it all, right? That's kind of how we, who are the legends that will survive the fall, which is a shout out to the thumbnail that we created for this show, Legends of the Fall. So let's look no further than Inman. Maybe Inman would have something encouraging to tell us.
They're here for realtors, right? Of course.
Yeah. So will legends survive? Let's look at these legends. The title says, real estate companies are about to tell us just how bad the downturn is. No reprieve for you today, guys. But look, they have a nice little GIF up here at the top again.
And everyone's happy and smiling.
Everyone's happy and smiling, but they're
the offer pad guy is super stoked right now. I don't know why.
Redfin CEO Glenn Kelman said his company had a fantastic quarter while revealing a 128% year-over-year spike in revenue at the end of the third. That was in 2021, the third
Right.
quarter.
Right. That's a year ago.
Yeah. Anywhere delivered excellent top and bottom lines this quarter, said CEO Ryan Schneider. Looking further ahead, we're excited about our growth prospects in 2022 and beyond, Remax CEO Adam Contos. But a year later, 2022 and beyond is not looking so hot. All right, so beginning in the year, mortgage rates, it kind of goes back through everything that we just talked about. Already 2 big companies have reported earnings, Anywhere, which reported revenue declines thanks to deteriorating market, and CoStar, which actually saw both revenue and profit tick upward. But here's what you need to know about the remaining reports. So CoStar, if you recall, they also acquired HomeSnap.
Yeah, that was supposed to be kind of the competition for Zillow and Trulia, right?
Right. And because of that acquisition, I wonder if that had something to do with the uptick that they had, where they were in a growth mode through a downturn.
Yeah.
Can iBuying survive the slower market? One of the biggest questions going into this earnings report was what happens to the iBuyers in a market where homes are not appreciating quickly or at all. In earlier years, when price growth was strong, companies like Opendoor and OfferPad would buy houses and sit on them for a few weeks and theoretically sell them at a profit. But it's not like that today, which raises questions about the viability of the model. Mike Del Preet, which we talked about, reported in September, Opendoor was selling homes at a loss for the first time. Big iBuyers have recently seen their share prices drop to all-time lows. In the case of OfferPad, which has been profitable for all, at least of 3 quarters, share prices have dipped.
Ray, we have some breaking news. You wanna play the sound?
Oh,
it's not the Fed announcement.
Okay,
go through it.
Breaking news from this week in real estate.
Opendoor, this just in from Inman. Opendoor lays off 18% of its workforce ahead of Q3 earnings.
Oh, wow.
Yeah, if you want to bring it up, Matt just sent that to our group.
Okay.
So thank you for that, Matt.
Thank you. Is somebody vacuuming?
There's some work going on next door. Yeah.
Oh, there it is. Opendoor.
Yeah.
All right. Let's share this tab instead and pull it over. There you go. Opendoor lays off 18% of its workforce ahead of Q3 earnings. Now, last week we talked about the proper way to lay off people and talk about it. Do you remember this discussion? It was
we've had it multiple times on the show.
Yeah. We've become really efficient, and so now we're making cost cuts to make sure that we can be profitable in a higher rate environment. Right? Let's see what it looks like. They cut approximately 550 people. Let's see what his quotes are. The reality is we're navigating one of the most challenging real estate markets in 40 years and need to adjust our business. To manage through the turbulent market, we worked quickly over the last 2 quarters to reduce our operating expenses. Well, that was actually pretty cut and dry. That's good. I think he said something in the past that was like, actually, that was pretty cut and dry there too. Wu further explained that Opendoor scaled back their capacity to over 830 positions, primarily by reducing third-party resourcing. The blog didn't go into further detail. Additionally, Wu wrote, we eliminated millions of fixed expenses. The layoffs come after 6 months of skyrocketing mortgage rates. Yeah, which we've talked about. There's the Opendoor stock.
Well, my biggest question is, I mean, through the 2 years of really high markets, these iBuyers were all still losing money. They were losing less money than in previous years, right? They'd go from 100 million in losses to 55 million in losses, but now an economic downturn and a housing correction, we'll call it. I don't think it's a true correction yet, but how are they going to be profitable when they weren't during the hottest market in the history of the housing market? You know,
that's a good question. I mean, if they're a flipper, how are they going to possibly be profitable flipping as they buy a house? Well, and the market turns down.
They buy large amounts of houses too. These are not small investors. These are very large investors. What was it when Zillow killed? Sorry, that'll get a YouTube strike. When Zillow offed their iBuyer program, weren't they holding 20,000 listings or something crazy like that?
Yeah, it was some crazy number. It was around 8 million or so, I think it was. And maybe an inventory, some number like that. I can't remember the exact one. So back on the article about these reports, the key questions: did any iBuyers manage to turn a profit? What kind of inventory did the iBuyers holding on to right now, and how much cash do they have? How many transactions are iBuyers doing? What's their average sales price? OfferPad is reporting Wednesday, November 2nd, which is today. Open Door is reporting tomorrow, which is why they probably announced the layoffs today, because those numbers probably aren't going to look good tomorrow, which is why they are trying to cut ahead of that number, or at least. Redfin is next week, Wednesday the 9th. Rising agent counts have been a key part of the story, as fast as newer brokerages such as Compass and eXp Realty. Even older companies such as Keller Williams publishes agent count numbers, despite being a private and thus not having any obligation to. However, as Gorman pointed out during this recent conversation with Inman, cooling markets typically see the overall number of agents in real estate drop, which means there's more competition for the remaining agents and more attention to those who are actually picking up top talent, as well as high-producing teams. Then they give you some key questions there too. So reports to watch: eXp World Holdings. Actually, breaking news from this week in real estate. eXp just released their numbers as well. Revenues slide. Revenues rise. So eXp has increased in revenues. Well, look at that. And profits fall for eXp amid a challenging Q3.
Wait, what?
Revenues are up for
Okay.
eXp.
That's great.
They're making more money top line.
Right.
Yep. So they increased 12% to
Okay.
1.2 billion.
So they're
in the
doing
third
great.
quarter. Yeah. I mean, that's really good. Profitability slid 81.5% to 4.4 million. But you know,
Wait a second.
yep.
Wait, what? 12% up?
Yeah. No, yeah. They 1.2 billion.
That's a big number, Ray.
Yeah,
That's like
a lot of revenue.
that's 1/44th of what Elon bought Twitter for. That's great.
Yeah. When you put it like that.
That's great. But
So the
how's their
revenue
profitability though?
this increase in revenue was fueled by double-digit agent count, growth, and increase in ancillary services.
And then how's their profitability? This is all great stuff. How's the profitability?
So their net income dropped 81.5% from 23.8 million in Q3, one of its best quarters ever, to 4.4 million. Did they buy something? Like, what is that? So let's just put it in thousands, okay? If one quarter I made $23,000,
Yes.
the next quarter I increased my revenue and made $4,000. The question would be, what did Ray buy for about $20,000?
Because if it wait,
Did they buy something?
But if it increased 12%, so that would be roughly $2,500, right? So you'd go up to about $25,000 in the quarter, but then you spent $22,000.
Yeah. What? On what?
Or what are they not reporting?
You could not do anything, right? They could do nothing. They can make no changes and no growth, and theoretically have had a better quarter. But whatever they did, increased revenues and dropped. That's
I mean, 81% is egregious.
That's wild. eXp delivered a record third quarter with 12% revenue growth and continued to deliver positive cash flow and earnings.
Do we have
That's how you couch that. For my CEO friends out there, that's how you say it. eXp delivered record third quarter with 12% revenue growth and positive cash flow. Reflecting the agility of our business model, we continue to gain market share and drive growth while focusing on increasing operating efficacies.
Efficacies.
I know, but I like to say efficacies.
Efficacies. It's so aggressive.
Whiteside and eXp Holdings, Clint Sanford both touted a 30% boost in agent count. Is a crown jewel of their Q3, which placed them at 89 agents, shy of their goal of 85,000 agents before the end of 2022.
Maybe it's the agent count that went up. They have to.
Yeah, agent count went up, but I mean, you're still
So you
driving.
got to pay out. But how do you?
You don't
81% down?
backwards count the volume of those agents like some companies do. You don't backwards count the that was a shot in the dark to someone local. You don't backwards count volume towards a company that you didn't participate in. So that's not it.
I don't know. That's intense. Because are we covering that story on here today? Or Dusty sent it, I think, right?
Which one?
The EXP is having a rough Q3 because this is relative
That's
to that.
that's it. That's this one. That's this one.
Because this is I didn't know about the 81%. I didn't read that.
Yeah.
That's
CEO said he's confident in the brokerage's ability to maintain robust recruiting and retention rates if it launches a new slew of agent programs. We continue to grow revenue. They're trying to launch an EXP luxury, but they said it's like trying to turn the Titanic, which that's not a real great statement to include in your press release, but that's what they said.
trying to turn the Titanic.
Yeah. They closed 138,354 transactions, which is a plus 6% year over year.
All those things are up. That should
worth $50 billion, which is plus 8% year over year from June 1 to September 30th.
Yep.
So but their profitability is down.
That's insane to me. And Olivia has a good comment. He says, doesn't this underline the problem most brokerages have? They charge agents less, but the expenses are increasing, hence no profit.
Yeah, but they didn't change their payment structure to agents. And actually, one of the things we're not covering this week is something that Realogy said. And I guess the reason why we're not covering it is because I put it on my Instagram. Anywhere, I mean. They said that they are going to be, and this is just, it's on Real Deal. It was said by one of the people, but there's no like official press release or something about this. But they said that they would be taking more from basically the Anywhere brands were going to start having to take more money from agents.
Yeah, which we kind of hit last week, but not brokerages. It was for the
Homelight
and Zillow and with all of their, what do you call those programs? They're
referral programs.
Yeah, where you don't pay us for this referral until you close. But if it's $900,000 or more, you're going to pay us 40% of that referral.
Yeah. All right. So to continue with those press releases, Remax is releasing Thursday, November 3rd. Keller Williams, Wednesday, November 3rd. Wait, that's a typo. Thursday, November 3rd. It's not me. I'm going to share the screen. That wasn't me. That's the wrong screen.
Is it possibly because of EXP's share profit, like their profit share?
The rev share, you mean?
This forever. Like
if your revenue goes up, your agent count goes up. So anytime your agent count goes up in a situation like that, that means you have people joining on the quote lower limbs of these rev share type systems.
They're not.
So they're going to be paying in more than the people that are up. So anytime you have additional people joining, you should have an increase in revenue if sales also increase.
So wait, Ray,
an 81.5% drop is pretty crazy.
So Ray, you're kind of saying it's like, if you see my visual here, those, you know where I'm going, Ray, but for the Clubhouse listeners, I got my hands next. So it's kind of like the lower agents, and then it kind of goes up like this into kind of a triangle shape, kind of.
Yeah, you could say the triangular here. I've got an illustration.
The lower agents kind of support the upper agents, kind of like a pyramid, kind of.
Yeah.
Right.
Well, I mean, that's one way to phrase it. I guess you could phrase it that way. There you go.
There it is.
It's from The Office.
That's exactly where I was pulling from.
It's not a pyramid.
Ray and I disagree on most things, but The Office, he knows that I'm already thinking The Office.
Yeah. So yeah, there it is. Not a pyramid, it's a triangle.
It's not a pyramid, it's a triangle. Yeah, I did it in reverse though. As
you have people on the lower rung of your triangles, they're going to be paying more, you would think. So I don't understand.
That should help them in theory.
Maybe their rents went up. I don't understand how you can have an increase 12% in revenue and a decrease 81.5% in profit,
or 20% decrease on profitability, something a little to balance each other out. But 81% is not balanceable. That one side of the scale is very heavy there.
Yeah, Okay, so some others. Redfin is releasing a report November 9th. Rocket Companies, November 3rd. These are the loan companies. Keller Williams, November 3rd. It did it again. They made the same typo. Rocket Companies, Thursday, November 3rd. Keller Williams, Wednesday, November 3rd. We know today is November 2nd, so we're just going to go ahead and say that Keller Williams sent the wrong dates. Or maybe they only made the typo on all the Keller Williams lines. Why?
And obviously they're copying and pasting.
Yeah, they're just copying and pasting from what the person sent it. What the person at some office in some cubicle was like, oh, we got to get these release dates to Inman. They want to know.
Yeah, and everyone's now copying and pasting for the same article.
At the very bottom of the article, it says, how bad is the downturn? One of the big questions real estate right now is how bad will things get and how long will the downturn last? The numbers in the reports offer hints on these topics, but also the reports or subsequent investor calls always include commentary from top executives. That means that it's a rare chance to hear folks like Rich Burton, Robert Refkin, Glenn Kelman, Glenn Stanford, Eric Wu, and many other top leaders directly address the state of the market. Earnings reports often include a bit of company, they're boosting their company. But investor calls involve executives taking questions from analysts, which means the calls tend to produce off-the-cuff, occasionally colorful commentary. So yeah, watch for those calls. That'll be fun. I do want to say, though, the investor calls are generally pretty good because those investor calls, they can't lie because the SEC. And if they use marketing speak in those investor calls, they normally get called out on it and they can get in trouble for it. So they pretty much just have to say, here's what it is and here's what we're doing. One of the companies, and I can't remember, I want to say it was Redfin. I could be wrong. But there was a company that said something. Oh, no, it was Zillow. They said something publicly about the direction they were headed. And then the next week had an investor call and totally said something different. They changed the way that they couched what they had said publicly.
They couched it.
All right. Let's look here. Do we have it?
Yeah, Mike B says
breaking news with This Week in Real Estate from your host, the bearded man of real estate. The Fed approves a 0.75 point hike to take rates to its highest since 2008 and hints at a change in policy ahead. And this is what, where is he? This is what Assad said. Assad, are you still with us? Come on up, buddy.
Yeah, so get it out there, guys. Go to your Instagrams right now and tell everyone that their interest rates go from 7 to 7.5 right now. Get it out there, guys.
Yeah, it's not. So the Federal Reserve on Wednesday approved a fourth consecutive 3/4 point increase, a rate increase that signaled a potential change in how it will approach monetary policy to bring down inflation. In a well-telegraphed move that markets have been expecting for weeks, the central bank raised its short-term borrowing rate 0.75% points to target a range of 3.75 to 4, the highest level since January of 2008.
Now, is this the third or fourth 0.75 hike? Third, right?
This is the fourth consecutive.
Fourth. And they've
no, wait, I'm sorry. Yeah, it's the fourth consecutive 3/4 point increase. Yeah. Most aggressive pace of monetary policy since the 1980s. Along with anticipating the rate hike, markets also have been looking for language that included it would last 0.75 point hike. Specifically, some Fed officials, along with Wall Street economists and strategists, in recent weeks talked about a step down in policy. Language was not overt in the post-meeting statement from the rate setting Fed Open Market Committee, though there was a tweak that could point to an adjustment in policy. They said, quote, ongoing increases in the target range will be appropriate. That's what they said. The new language, sorry guys, I'm reading as we go through this. The new language said, quote, the committee anticipates that ongoing increases in the target range will be appropriate in order to attain the stance of monetary policy that's sufficiently restrictive to return to a 2% inflation over time. We'll take into account the cumulative tightening of monetary policy lags with the monetary policy effects on the economy. and economic and financial development. All right, I'm reading through here quickly live. So we were the first real estate news outlet to break the news that the Fed is going up. Let everybody know. It's right here in the show. An hour into the show.
First real estate podcast to report on this.
That's right.
We are. I'm just making
first
the
and
claim.
I would say, I'm going to go ahead and say the best.
And the best.
And the best.
Yeah.
Throwing it down. Dusty said no one should be surprised that we're the best.
Right.
I think she's actually talking. She may be talking about the Fed.
No, she's talking about us.
D Jones agrees.
Yeah.
She says that LMAO, which means I agree.
Yeah.
All right. So the Fed fund rate, that is the rate that goes between the banks so they can loan each other money.
Short.
So that is now increasing. So they can now loan money to other banks at a rate that's better than what they could give you the money for. So in order for you to obtain this money that they're going to give to another bank, you have a higher risk than giving it to another bank. So they're going to charge you more interest. That's basically how it works. It's a very basic premise. Okay. So I think we have also exhausted all the real estate companies are telling you it's bad. But I did want to bring up one more real estate company that maybe there's a silver lining in the old CB star.
So Matt asked, can we hear something positive about real estate today? This is it. This is your one shot to get something positive about today.
So this is the Coldwell Banker CEO. And he said, not every company will make it through the slump.
Dang it.
The housing market is slumping and the stock market is in the ditch. Interest rates just keep rising. An uptick will overall economy won't appear to be buoying up real estate any much. These are tougher times. I was reading real fast.
But Coldwell Banker did have a good third quarter, though.
What did they release their numbers?
Yeah, I sent that. Here, I'll find it.
Oh, okay, good. I haven't seen their numbers yet. Comparison to prior market shifts. So this was a question that Inman asked in a speech you gave at Jim Blue. One of the first things you hit on was the market shift. Talk to me about when it's substantial. The previous market shifts can always be a little dangerous, especially because the most recent and most significant shifts were pretty unique. So the last shift being the Pandy related shift, I don't think that we're seeing anything today like we saw in either one of those, the Pandy or the housing crisis. But I still think it's significant, he says. How long do you think it's going to last? It's difficult. He says it's difficult to peg a bottom or a top of the market, but I'll say for a long-term perspective that I'm a big believer in housing. Okay. You were just at Jim Blue. They keep saying Jim Blue. Was this an Inman sponsor conference? He said, we know how everybody feels. He was like, well, how do agents feel? We know that because a lot of us are agents. And we've been talking about it for an hour.
This is weird. I'm reading the Coldwell Banker. It's from Yahoo Finance. Sorry, Ray. Yahoo Finance.
Yahoo.
You want me to read it a little bit real quick here?
Yeah. Get into it while I'm looking. I'm trying to take some nuggets away from his speech, but it's basically the general stuff that we all know. It's not.
So this one starts off, and this was, like I said, from Yahoo !finance.com. And it says Coldwell Banker. This is what it's titled, and it doesn't have any fun gifts, which, you know, I
really they could use some gifts over on Yahoo Finance. I'm sure they would love.
It would attract some more clicks, I believe. Coldwell Banker Real Estate reports strong Q3 2022 results. So it doesn't say up, down, nothing. There's no actual numbers here, but Madison, New Jersey, November 2nd, 2022. Coldwell Banker Real Estate LLC and Anywhere, that's formerly Real OG Real Estate brand, reported strong third quarter results through the retention of franchise agreements accounting for more than $6.2 billion in sales volume. Building on momentum from the first half of the year, Coldwell Banker Real Estate welcomed 5 new affiliated companies to the Gen Blue network in Q3 2022.
Gen Blue must be their thing. Their conference.
Yeah. They have,
Okay.
and they name them all. There's one in Montgomery, Alabama, Lawton, Oklahoma, Vienna, Virginia, Westminster, California, which is near where I grew up, in Galveston, Texas. So it doesn't really say what's like any numbers. It just is powered by its network of over 100,000 affiliated sales professionals in approximately 2,200 offices across 40 countries and territories. The Coldwell Banker Coldwell Banker registered trademark organization is a leading provider of full service residential blah blah blah. There's no numbers. There's no numbers.
Is that because they're a part of Anywhere, so they don't have to break out specifics?
Yes, because there's literally no numbers. It just says, hey, we added a bunch of new brokerages essentially, and that's a bunch of new affiliates, and we've had a strong third quarter. But what are your actual
all they're talking about everywhere that I'm looking is just talking about that 6.2 billion in sales volume. They're not talking about profits anywhere.
Right, because what if they were up 12% and down 81%? You think we'd talk about that, right?
Interesting. I think Anywhere is going to have to be, the parent company is the one that's going to have to talk about it. But Anywhere already released a statement that said their profits are 50% less than what they were last year, and that's why they're going to be taking more money away from the agents. That was on The Real Deal.
Interesting.
Let's see. They report. All right. So this is Anywhere's report.
This is just the same. There's no numbers behind it. Just the 6.2 billion. Everything I find is the same 6.2 billion in sales volume, and welcomed 5 new franchisees. That is interesting.
Welcome to the show where you watch Dan and Ray read financial reports live. It's so bad. Anyway, you guys, if you want to know, look it up. But yeah, Realogy is Anywhere is the one that's going to have to release the numbers, I think, for Coldwell.
Yeah, and there's reports. So 6 days ago, it says they're going to release. Let's see. It doesn't say when they're going to release.
Desi says so Coldwell Banker did well, but the rest of their business family is tanking. I don't know that Coldwell Banker did well. We know that they had 6.2 billion in profits, but as we've already seen from EXP, or 6.2 billion in revenue, but as we've already seen from EXP, that sales volume number doesn't mean jack squat when it looks at the bottom line of profit.
Well, here I'll cover their. This is Anywhere Real Estate's Q2 financial results. Okay, so this is an older article, but it says generated revenue of 1.8 billion. That's Anywhere. That's not Coldwell Banker, and that's a decrease of 17% year over year, largely impacted by lower home sale transaction. Blah blah blah. Report net income of 55 million, a decrease of 59 million versus prior year. Generated operating EBITDA TDA of 166 million. That's a decrease. Everything was a decrease. So how is
so they had revenue, but everything else decreased. So it is a 50%. Yeah.
So I think Dusty has it right. So, or maybe it's just they did less bad.
Of all the families, maybe they did less bad.
Yeah, maybe they did the best out of the family. They were the prized child, the golden child in this quarter, or they did less bad than the others.
Well, if there's one place you can go for sensational positivity, in my opinion, it's Keller Williams. And Gary Keller says 2022 is poised to become the second worst deal year in history. Keller Williams co-founder Gary Keller just laid a stark view of the current real estate landscape, comparing it to the Great Recession and saying we're on track for the second worst year ever. He added that even in times of crisis, there are opportunities. There's the positivity.
Yeah.
So, and I hope you guys understand, we're going through this, but it's kind of to give the general feel of what's happening at the market at the CEO level. And you can tell that there's a lot of CEOs that are talking about the downturn. They're talking about the shift. And a big reason why they're talking about the downturn right now is because they're all releasing third quarter profit numbers that are not good. Gary Keller's not releasing any profit numbers. He didn't have to release profit numbers, but agents in those companies can report profit share and they can see what they're making. or not making due to the increase in expenses and office expenses and all that, because their profit share is bottom line share and not a rev share, which is top line share. So it is, and he's got to be somewhat forthcoming with those numbers because they claim to be open book. But at the same time, he doesn't have to say any of this. Things are likely to get quite bad this year, but thanks to rising rates and increasing unaffordable homes, among other factors, he did predict a dip of about 1.3 million in transactions for the overall market. He said the current market has some unique characteristics that offer hope. Unemployment remains low, for instance, and Americans have more cash and equity than they did in the Great Recession. Moreover, days on market for homes remain low, suggesting in Keller's world that demand is off the charts. The real opportunity for any disaster or shift, if you will, is that what happens when you come out of it. Right now, the winners will be those who look up and go. Say, okay, we're able to double down on our value proposition. We're able to double down on lead gen. We're able to double down on staying connected to our database. I do not argue with him there at all. I think he's exactly correct.
That's what you have to do.
Yeah.
I think that's the only option. Those core clients that you have to stick close to them right now, and you have to reach out to them more than ever. And it's the fall, so make sure they're getting lots of pumpkin spice lattes and pies.
Yeah, and I think the opportunity there, Matt Lamarche says, where's the positivity? The opportunity there is to do exactly what Dan and Keller said. Double down on those things that are working, and the opportunity is for real estate agents that actually do the work. If you're a real estate agent out there and you're not doing the work, and you're kind of, maybe flying by the seat of your pants, or maybe you're riding on the coattails of this incredible market and putting a sign in the yard and hoping it sells, you are in for a really cold winter. But if you're not afraid to get out there and do the work, if you're not afraid to make your calls, if you're not afraid to run some ads, put out some content, go to door, send market reports, do CMAs, do the stuff that real estate agents were supposed to be doing through all those high notes.
A lot of these agents don't know to do that, though.
Yeah. Then that's where you'll make the monies. Yeah. And if you don't know to do that, you should probably partner with a broker or a team that will show you.
Or
because
me.
That's going to be a part of it.
Those are the agents that I've been helping. Those exact agents right there.
There you go. Speaking of helping, Dan, could you tell people where they can find you?
You can find me riding the silver wave that is going to be coming next year.
That's right.
Is that part of my prediction for next year? You'll have to watch. We have a prediction show coming up, but find me over on, it's right here. It's DLUDWIGROCKS, D-Lettered Rocks. On Instagram. You don't need to follow me anywhere else. Everywhere else sucks. Don't go to Twitter. It's a dumpster fire. Ray, where can they find you?
Matt Lamarche agrees with you. He said massive transfer is going to happen in the coming year. You can find me at Ray Zorback, RAYZORBACK, everywhere good Razorbacks are sold, including Instagram. Actually, just find me on Instagram. If from there there's a jumping off point, you can find everything else there. I also have a list I'm working on. I have links. There's a link tree there with everything. There's a show. I actually have all the equipment and everything I use to produce the shows there. There's masterminds there. There's an incredible amount of information there. So follow me on Instagram. Howard says, have a great day. Regards from Haifa. Thanks for joining us, buddy. Thanks everybody for coming. Thanks for joining us live. Thanks for the input. We love the discussion, and we will see you guys next time.
I'm gonna bundle up.
Bundle up. Survive the fall, everyone. Survive. Don't just survive. Thrive.
You can thrive.
Thrive.